In this video we're going to be using exercise 14-5 to illustrate how to prepare a statement of cash flows using the indirect method. We're going to be starting with net income, which you can find at the bottom of the income statement. In this case it's 75. Next we're going to add back the accumulated depreciation credits for the month. Well, all we know is that there was a change in accumulated depreciation of an increase of 40. We have to look a little bit further into it before we can say that all the credits were 40. So if you put together a T account for accumulated depreciation, we know that the change was 40. So hypothetically, let's say we started at 100 and we ended at 140. It's quite possible that we might have sold some property, plant, and equipment that had some accumulated depreciation attributed to it during the period. When we look further into the problem, we see that we sold land. Well, land does not have any accumulated depreciation, so any accumulated depreciation debits that we would have had for this period would have been 0. Therefore, the accumulated depreciation credits must have been 40. So we're going to add back the accumulated depreciation credits of 40. Remember, we're starting with net income. Depreciation expense would have decreased net income by 40. Since that's a non-cash item, we add it back. Next, we're going to look at our short-term assets that really affect net income. The first one is accounts receivable. And we can look at the change in accounts receivable, which is a decrease of 10. Well, if accounts receivable goes down 10, that means that we collected on account more than we sold on account. So that's a positive cash flow of 10. So when your asset goes down, that's good for cash flows. An increase in inventory. Well, if we had an increase in inventory of 30, that really means that we bought more than we sold. Cost of merchandise sold takes care of the cost of the merchandise that we sold, but some of our inventory wasn't sold. So an increase in inventory, think of it this way, you bought more inventory than you sold, therefore you have a negative cash flow of 30, so we'll subtract that. Decrease in prepaid expenses. Remember, prepaid expenses are an asset, and this asset will be expensed when we use it. So if we have a decrease in prepaid expenses, we actually used more than we bought. So you could say that your expenses are more than your cash outlays for those prepaid expenses. Either way, if your prepaid expenses goes down 5, that's going to have a positive cash flow impact, so we're going to add that 5. Next, we're going to look at our short-term liabilities that affect net income. Your increase in accounts payable, well, that's good. That means we owe more. If you owe more, you paid less. So since we increased accounts payable, that has a positive cash flow. Same thing with income tax payable. Income tax payable increased 15. If we owe more, that means technically that we paid less, and that's a good cash flow experience. The decrease in accrued liabilities. Well, it seems to me then if we have an accrued liability, we would owe. If we had a decrease in accrued liabilities, we owe less. If we owe less, we must have paid more. So here we paid off some of the liabilities that we had accrued over the period. As a matter of fact, we paid off more accrued liabilities than we incurred to this period. So since accrued liabilities went down 10, that means we must have paid off 10 more than we accrued, so there'll be a negative cash flow experience. And finally, we have to look at our property, plant, and equipment and other investing activities in which we had a loss or a gain on. This loss on the sale of investments, if you read through the problem, you see that they tell you had a loss on the sale of investments. Well, that's an investing activity, but that loss negatively impacted net income. Well, that's not an operating activity. Right now we're just looking at the operating activity section. So we have to add that loss back since it's a non-operating activity. So we'll add that 5 back. Same thing with the gain on the sale of land. We had a gain of 40, so that increased your net income, but it wasn't an operating activity. So we're going to take that 40 out. Now remember, this is just a trick that we use to really explain the difference between net income and cash flows. If we use the direct method, we would simply look at the cash inflows from operations, in other words, the collections from our customers, versus the cash outflows from operations, in other words, the money we paid to our service providers. Well, that doesn't really explain why net income is different. So by using the indirect method, you're able to see your net cash provided by operating activities, but also explain the difference. If we sum all of these changes from the indirect method, we see that the net effect on our cash flows compared to net income is 15. So net income, it comes from operations, but some of those items are non-cash and some of those items are non-operating. So we had to back out the depreciation because it's non-cash. We had to back out the loss and the gain because it is non-operating. And in the end, we end up with a change of 90. So you take the 75 in net income plus the extra 15 of adjustments, and you can see that our net cash provided by operating activities is 90. Please remember that this is just kind of like an accounting trick that allows us to see our net cash provided by operating activities, but it looks further than just what did we collect and what did we pay. In our next video, we'll go into looking at the other sections of the statement of cash flow.